All right. Welcome back, everyone, to another deep dive. So this time we're looking at large cap growth stocks with high dividend yields. Pretty interesting area to look at. We got a few companies in front of us to look at today. Altria Group, BP, Verizon, IBM, and ExxonMobil. Some of those might surprise you. So let's take a look at what makes them stand out.
Yeah, I think the appeal here is obvious. You get the growth potential of the company as it expands and increases in value. And on top of that, you're getting those high dividend yields. So you're getting paid out regularly too.
Yeah, that's right. It's like you're investing in a fruit tree that's growing taller and taller. But it's also giving you a basket of delicious fruit every season. So you get the growth of the tree and you get the income from all that fruit. So let's jump into our first company, Altria Group. This one might raise a few eyebrows. We're talking about the company behind Marlboro cigarettes.
Yeah, Altria. It's really interesting from an investment perspective. They've been able to navigate a challenging environment, maintaining a strong market position, and they generate a substantial amount of cash flow.
Yeah, and as of January 27th, 2025, they're offering a dividend yield of around 8.03%. So that's some serious passive income potential. It really makes you think about how they keep those dividends flowing, especially in an industry facing so much scrutiny.
Well, I think a key factor there is their commitment to diversifying their portfolio.
Yeah.
They're not just relying on traditional tobacco products.
Yeah.
They've made some investments in alternative tobacco products, and they've even ventured into the cannabis market.
That's a bold move. Venturing into cannabis seems like they're not afraid to take risks to keep those profits coming. Speaking of bold moves, let's shift gears and talk about BP, a global oil and gas giant. I know fossil fuels are a hot topic, but remember, we're looking at this purely from an investment standpoint.
BP is interesting because they're actively transitioning toward those low-carbon energy sources, which aligns with the global trends, and it really positions them well for sustainable growth.
And as of January 27th, 2025, their dividend yield sits around 6.17%. Not bad for a company going through such a major transformation. But what's the secret sauce behind those attractive dividends while they're making such big changes?
I think one key aspect is their commitment to shareholders. Through things like share buyback programs, when a company buys back its own shares, it can increase the value of the remaining shares, which is a definite plus for investors.
That's a good point. So BP might be worth considering for investors interested in energy, but looking for a company focused on the future. Now let's move on to a company everyone knows, Verizon, the telecommunications giant.
Yeah, Verizon. They've got that extensive network infrastructure and a massive customer base. It's hard to beat that kind of market dominance.
And when it comes to dividends, they deliver. As of January 27th, 2025, their dividend yield is around 4.9%, steady and reliable, kind of like their phone service, hopefully. But are they just relying on their existing infrastructure? Or are they innovating to stay ahead?
Well, what's interesting is they're not just resting on their laurels. Verizon is making investments in 5G technology, which is essential for staying competitive. And they're branching out into new areas like digital media and advertising.
That's good to hear. Expanding into those new areas could really help boost their growth. Now let's talk about another tech giant, IBM. This company has such a long and fascinating history. How have they managed to stay relevant in such a fast-paced industry?
IBM, they have a knack for reinvention, always focusing on innovation and strategic acquisitions, which is key to their longevity.
And for investors who like a little dividend bonus with their tech, as of January 27th, 2025, IBM is offering a dividend yield of around 5.2%. Not bad at all. But what makes those dividends sustainable?
Well, their strong financial position is definitely a contributing factor. And they also have a history of share repurchases, which can benefit investors.
Sounds like they're committed to their shareholders for the long haul. Okay, that brings us to our last company for today, another energy giant, ExxonMobil.
ExxonMobil. They're one of the world's largest publicly traded oil and gas companies, a truly global reach, and a long history of operational efficiency.
And as of January 27th, 2025, their dividend yield sits at a respectable 5.4%. It's interesting to see how they balance their oil and gas operations with the growing focus on sustainability and renewable energy. How are they navigating this transition?
Well, they're aware of the changing energy landscape and the emphasis on reducing emissions. So they're investing in both traditional and alternative energy sources and working to improve their operational efficiency.
So they're trying to position themselves for the future while still capitalizing on their current strengths. Well, we've covered 5 very different companies today, each with its own unique story. An approach to growth and dividends. I'm curious to hear what stands out to you about this group as a whole.
Yeah, it's fascinating to see how these companies are approaching the same goal. That growth with those high dividend yields
Yeah.
from such different angles, like they're all operating in such distinct industries, facing unique challenges. What's your perspective on how these factors might influence their long-term success?
Well, I think it really highlights the importance of diversification. You got companies like Altria navigating the changes in the tobacco landscape, but still delivering those strong dividends. Then you have BP and ExxonMobil dealing with that energy transition, investing in a more sustainable future. And then there's Verizon and IBM constantly innovating to stay on top of the tech world. So it just goes to show there's no one-size-fits-all approach to investing. Right. So for our listener out there, who's thinking about building a portfolio with these types of companies, what are some things they should be thinking about? What questions should they be asking themselves?
Well, before they even look at specific companies, they need to understand their own investment goals and their risk tolerance. Are they looking for income primarily? Or are they trying to balance growth and income? How comfortable are they with companies in industries that are facing some challenges or disruptions? What level of volatility are they okay with? These are all important questions to answer before diving into any specific company.
Yeah, it's like planning a road trip. You wouldn't just hop in the car and start driving without knowing where you're going or what kind of roads you're comfortable with. You need to know your destination and how bumpy you're willing to let the ride get.
Exactly. And once you've got those goals and risk tolerance figured out, then you can start looking at companies with a much more informed perspective. And it's important to look beyond just that dividend yield. You really need to understand the company's overall financial health. How strong is their balance sheet? How much debt are they carrying? What are their growth prospects? Don't forget to consider the competitive landscape. Are they facing tough competition? Or are they leaders in their market? And of course, take a look at their management team. Are they experienced and capable of guiding the company through those tough times?
So it's really a whole package deal. We've talked about the what, these 5 companies and what makes them unique, and the why, the appeal of investing in companies that offer both growth and income. But let's get practical. What about the how? What are some concrete tips for our listener who's ready to start exploring these companies?
Well, diversification is key, as we see with this group of companies. They all have their own risks and opportunities. Spreading your investments across different industries and companies can really help mitigate your risk. Don't put all your eggs in one basket.
Yeah, that's classic advice. But how do you actually go about diversifying effectively?
Well, one way is to consider building a portfolio. That includes companies from different sectors, like energy, technology, consumer staples, and things like that. You can also diversify within those sectors. For example, in the energy sector, you could invest in companies focused on traditional energy, like ExxonMobil, but also companies like BP that are transitioning toward renewables.
So you're creating a safety net for your portfolio, spreading that risk. So if one sector or company underperforms, it doesn't tank your entire investment strategy. But diversification isn't the only thing to keep in mind, right?
Absolutely not. Research is crucial. Don't just rely on headlines or social media buzz. You really need to dive deeper. Read company reports. Analyze their financial statements. You can even listen to their earnings calls. The more you understand the businesses, the better equipped you'll be to make those informed decisions.
That's where it gets real. Getting into those company financials can seem intimidating, but it's definitely worth the effort. What are some key things to look for when you're digging through those reports?
One important metric is the payout ratio, which basically tells you what percentage of the company's earnings is paid out as dividends. Lower payout ratio usually means the company has more room to maintain or even increase their dividends in the future. You also want to look at their free cash flow. That's the cash they have left over after paying operating expenses and capital expenditures. Strong and consistent free cash flow is really important for a company to sustainably pay those dividends.
So you got to look beyond just the dividend itself. You need to know if the company can afford to keep paying it in the long run. Makes sense. Seems like a lot to consider. Are there any other resources or strategies that you think could be helpful for our listener?
Don't be afraid to seek out expert advice. Talk to a financial advisor or a trusted investment professional. They can give you personalized guidance based on your specific situation, goals, and risk tolerance. They can help you navigate the market and develop a sound investment strategy.
Yeah, it's like having a personal trainer for your investments, someone to help you set goals, create a plan, and stay motivated. But even with all the research and expert advice, there's still some uncertainty in the market, right? How do you deal with that?
That's where patience comes in. investing is a marathon, not a sprint. You're not going to get rich quick. Focus on building that diversified portfolio of solid companies. Reinvest those dividends and let time do its thing. The market is going to go up and down. But over the long term, companies with strong fundamentals tend to perform well.
It's like planting a tree. You nurture it, you give it time to grow, and eventually it bears fruit. You can't rush the process.
Well, we've given our listener a lot to think about today, but I want to change things up a bit. We've been talking about these 5 companies from an investor's perspective. But let's flip the script. Imagine you're not an investor. You're the CEO of one of these companies. What are the biggest challenges and opportunities you see?
Ooh, that's an interesting perspective. Okay, if I were the CEO of Altria, I'd be thinking about that long-term decline in smoking rates and the increasing regulations on the tobacco industry, but I'd also be looking at how to use those investments in alternative tobacco and cannabis to drive future growth. It's like a balancing act, managing that decline of their core business while investing in new, potentially higher growth areas.
It's like a tightrope walk.
Eh.
Okay, what about BP? What challenges and opportunities are they facing? If I were leading BP, I'd be laser focused on navigating that energy transition, investing heavily in renewable energy sources, developing new technologies to reduce emissions, but also managing the decline of their fossil fuel business. It's a huge undertaking, requires a ton of planning and investment, and a willingness to adapt to that rapidly changing energy landscape.
Steering a giant ship in a new direction. All right, what about Verizon? What's keeping their CEO up at night?
As the head of Verizon, I'd be worried about staying ahead of the competition. In that rapidly evolving telecom industry, the rollout of 5G is a big opportunity, but it needs a ton of investment and flawless execution. I'd also be thinking about leveraging their network and customer base to expand into areas like digital media and advertising, which could unlock new revenue streams and growth opportunities.
So they need to be innovative, but also strategic to maintain that market dominance. Let's move on to IBM, biggest challenges and opportunities. From the CEO's perspective.
If I were in charge of IBM, I'd be focused on transforming the company into a cloud and AI powerhouse, continuing to invest in R&D, making those strategic acquisitions, and attracting the best talent in those fields. IBM has a long history of innovation, but they need to keep pushing to stay relevant in the tech world.
They can't afford to rest on their laurels. Now, last but not least, ExxonMobil. What's on their CEO's mind?
As the CEO of ExxonMobil, I'd be facing the challenge of meeting global energy demands, while also dealing with climate change concerns and investor pressure to reduce emissions. They need to balance those investments in oil and gas, with their focus on renewables and carbon reduction, trying to appeal to both traditional energy investors and those focused on sustainability.
It seems like all these companies are facing that same tension, balancing their business models and investor expectations with the changing demands of the market and the world. It's a really interesting dilemma.
It is. It highlights how interconnected the global economy is and the expectations for companies to be both profitable and responsible.
Well, we've explored their financials, strategies, challenges, and opportunities. Now I want to put our listener in the investor seat. Imagine you're building that diversified portfolio. Which of these companies would you be most interested in exploring further, and why?
That's a great question. It really makes you think about your own goals, your risk tolerance, and your vision for the future. Are you drawn to the stability of Verizon, the innovation of IBM, the sustainability efforts of BP, the resilience of Altria, or the global reach of ExxonMobil?
Yeah, it really is a tough choice. They all offer that mix of growth potential and high dividends, but ultimately the decision comes down to you. What aligns best with your own investment strategy?
Exactly. You got to consider your own financial goals and how much risk you're comfortable with when you're making these decisions. There's no right or wrong answer. The important thing is that you understand the companies and that you feel good about your choices.
Couldn't agree more. We've given you a ton of information to think about, but the real work starts when you begin your own research.
Yeah, absolutely. Take what we've discussed today as a starting point and then go deeper. Look into those company reports, explore their financials, really get to know those businesses. The more knowledge you have, the better decisions you'll make.
It's like we've given you a map and a compass, and now it's your turn to explore.
Exactly. Who knows, maybe you'll find a hidden gem that fits perfectly in your portfolio. The world of investing is full of possibilities.
Well said. We hope you found this deep dive valuable. Remember, investing is a journey, so keep learning, stay curious, and enjoy the ride.